Hi everybody, welcome to Macro Charts and Insights. In this video we are going to investigate a popular statement from analysts that are bullish on the market. We are going to see if this statement holds any water. The statement that the bulls are giving is, stocks can still continue upwards from here, despite higher interest rates. Why? Because not every Fed rate hiking cycle has to lead to a recession. Just look at the mid-1990s. And to illustrate, here is an article from CNBC yesterday as an example of a similar headline. So is there any truth to this statement? Let's dive into this topic together. Here we go. So in the top chart, you see the Fed funds rate over the last almost 50 years. The green arrows show the 8 previous Fed rate hike cycles with the peaks circled. Gray bars in the top charts show the recessions. In the bottom chart, you see the S&P 500 over the same exact timescale. Now, after most rate hike cycles, you see a recession. Sometimes immediately after, and sometimes it takes a year. But most cycles show a recession after. When we look at the 6 gray recession bars running vertically across the charts, you can see in the bottom chart that they always correspond with periods where the stock market goes down significantly. Now, I said most rate hike cycles lead to a recession, but not all of them. 2 of them didn't. Have you spotted them already? The 2 that did not lead to a recession were the one around 1984 and the one around 1995. And especially that latter one in the middle of the 1990s is a topic of discussion here. This is the one that the market bulls mention as an example of a soft landing after a rate hike cycle. And the chart shows that even though short-term interest rates got hiked from below 3% to above 5%, no recession followed. And as the lower chart shows, also no stock market decline followed. So, do the bulls have an argument? This chart says yes. Rate hike cycles don't have to lead to recessions. In the last 50 years, the charts show they only did that 6 out of 8 cycles. But I want to add some more nuance into this analysis and give you some more insight. So let's continue one step further. To go one step deeper, I would like to show the correlation of the Fed rate hike cycles to the 10-year, 2-year yield spread. The spread is the 10-year Treasury bond interest rate minus the 2-year Treasury bond interest rate, and that spread over time is visible in the lower chart. Now you can see the correlation in the charts. Every time the Fed was in a rate hiking cycle, illustrated with the green arrows, the spread between the 2-year and the 10-year yield went down, illustrated by the red arrows. Which is actually logical because the Fed can only directly influence the short-term rates by hiking the Fed funds rate. Now we spoke about 2 rate hiking cycles that did not cause a recession. Can you see what the difference was between those 2 cycles and the other 6 cycles that did cause a recession? The difference is, in those 2 cycles, the spread between the 10-year yield and the 2-year yield did not go negative. The lower chart did not dip below 0, which means that the yield curve didn't invert. In the other 6 rate hike cycles, the curve did invert. This is an important nuance that says something about the aggressiveness of the rate hiking cycle. So, What does the past 50 years teach us? A rate hike cycle by the Fed does not necessarily mean that a recession will follow. A soft landing in general is a possibility. It happened 2 out of the last 8 times. However, when a rate hiking cycle by the Fed leads to a yield curve inverting, 6 out of 6 times it has been followed by a recession and a significant decline in the stock market. So far for the past, let's look at today and the second part of the market bull statement. That was, stocks can still continue to go up despite higher interest rates today. Well, if I look at today on the right-hand side of the chart, we see that we are in the middle of the ninth rate hike cycle of these past 50 years. We also see that this hiking cycle has been very aggressive, which is visible in the steepness of the top chart. More importantly, in the lower chart, the spread between the 10-year and the 2-year yield has been deeply negative, much more negative than the cycles of 2000 and 2007. So does that guarantee a recession is coming? Well, there are never any guarantees, only odds. But I personally am not betting on the odds of a soft landing and a good performance for stocks the next year. I don't see any big reasons why this time would be different than any of the other last 6 times we had an inverted yield curve. Now, if you do have a good reason why this time could be different, could you please mention that reason in the comments below? I'm always curious about different viewpoints, and it could be an interesting topic for a next video. And if you found this video interesting, then please click the like button and become a subscriber of the channel. Thanks very much for watching, and I hope to see you in the next one.